Hello, my friends. Today is March 23rd, and this is Markets Weekly. So, this week was a great week in markets. We had all the major US stock market indexes making new all time highs. The catalyst seems to have been the dovish Fed meeting, which we've already discussed. So, today I want to talk about three things. First, let's talk about how the bias towards easing that the Fed has showed is something that's pretty common among many other major central banks. Secondly, let's talk a little bit more about financial conditions. Now, Chair Powell told us that he thought financial conditions were restricting economic growth, but let's look at a number of other indicators that just suggest that he's probably looking at the wrong things. And lastly, let's talk a little bit about home prices and why I think they're poised to surge this year in line with everything else in the great crash up. Okay, starting with global central banks. So this past week, we had the Swiss National Bank kick off the rate cutting cycle among developed market central banks by surprising the market with a cut. Now, every central bank behaves a little bit differently. The Fed, as we all know, likes to telegraph things far in advance and often basically tries to hold the market's hand. The S&B is completely different. The S&B has a history of surprising the market. Notably, a few years ago, the Swiss National Bank had an exchange rate floor between the Swiss franc and the euro. The aim of the floor was to prevent the Swiss franc from appreciating too much. One day, the S&B woke up and decided that it didn't want the floor anymore, and so in the blink of an eye, we had the Swiss franc appreciate as much as 30% against the euro. I'm sure it was a painful day for some people. But true to its nature, this past week, the S&B surprised the market with a cut, and of course, the Swiss franc depreciated immediately in response. The rationale for the S&B's cut was that it felt that inflation is basically under control. Indeed, if you look at a history of its inflation projections, you'll see that they've progressively come down lower, such that at the moment, the S&B felt that inflation would be comfortably below its 2% ceiling for the foreseeable future. And if they think that, then obviously it makes sense to cut a bit. Now, what we see with S&B is also what we see in many other central banks as well. Last week, we also had a monetary policy meeting by the Bank of England. Now, in the prior meetings, the Bank of England always had, let's say, one or two people on their monetary policy committee voting for more hikes. This time, though, there were no more monetary policy committee members voting for hikes, and they had one person voting for a cut. Now, the market saw that and began to think that the Bank of England, the next move would be biased towards easing. After all, no one is voting for cuts. No one is voting for hikes anymore. And of course, in response to that, we saw the pound depreciate notably against the dollar. Looking at the ECB, recently the ECB had progressively lowered their inflation projections. And if the ECB is thinking that inflation is going to be lower than expected, then that also makes sense for them to begin thinking about cutting rates, and the market indeed has been pricing in a rate cut by the ECB in June. Now, many central banks are cutting rates, but not all. This past week, we also had the Bank of Japan finally, after telegraphing this for quite some time, get off negative interest rates, and now they are comfortably at 0% interest rates, even as inflation is at 2%. Now, I look at this more as the Bank of Japan going from extremely easy monetary policy to slightly less easy. But in any case, looking at the big picture, the large central banks in the world are slowly moving towards cutting. And I'm going to write about this week in my blog about how I think that maybe the whole is greater than the sum and how there continues to be notable upside risk in equity markets due to this synchronized easing. Now, the second thing I want to talk about is financial conditions. Now, the way the central bank works is that it does something, toggles with interest rates, so its balance sheet, and it aims to impact financial conditions, which in turn feed through to the real economy. Now, financial conditions is a pretty nebulous concept. when people are thinking about them, they usually think about a few things. Now, notably, let's say in the US, you can think about the 10-year yield. Now, if the 10-year yield is going up, well, a lot of people borrow in the capital markets at a spread to the 10-year yield. So, as the 10-year yield is going up or down, that affects borrowing costs, and that in turn can affect economic activity. Looking over the past few months, the 10-year yield peaked at about 5%, and that since then basically trended lower and is, say, 4.2, 4.3 this past week. So obviously, the 10-year yield has come down, and that would be a sign of easing financial conditions. But as we discussed earlier, people don't borrow at the 10-year yield unless you're the US government. You usually borrow at a spread to the 10-year yield. And so we can also look at credit spreads. Usually when financial conditions are tight, credit spreads are quite wide. That's because when financial conditions are restrictive, well, there's a higher probability that a company might not be able to repay its loans, so the lender will want more of a premium. Now, a graph of investment-grade credit spreads shows that credit spreads have been steadily narrowing the past few months and are historically, kind of low. So you definitely don't see tight financial conditions over there. Again, you can also look at other corners of the market, equity markets going at all-time highs. We had Reddit do its IPO this past week, and it surged 40%. Not necessarily, wouldn't say that suggests tight financial conditions. And of course, you can look at more speculative corners of the market like crypto. Now, Bitcoin didn't have a great week, but zoom out a little bit, and they just recently made all-time highs. Many other meme coins have been surging as well. So again, there are many things to look at when it comes to financial conditions. And so people create indexes that try to take all this together and come up with a number to indicate whether or not financial conditions are tight. One of these indexes is produced by the Chicago Fed. It's called the Chicago Fed National Financial Conditions Index. And if you look at it, it'll tell you that financial conditions have been steadily easing over the past few months. There are many other indexes, and they all tell the same story. So it's very clear to anyone in the markets that financial conditions have been easing. And yet, when Chair Powell was asked about this is his reply.
Ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate.
So he tells you that, he looks at financial conditions and he thinks that they're constraining economic activity, and he points to the labor market as proof, which is kind of strange because if you look at the non-farm payroll report, it's pretty obvious that jobs continue to be created in a robust manner. If you look at wages, they have been moderating, but a big part of that has been the surge in migration. The Congressional Budget Office is estimating that we had about 3.3 million migrants the last year, many of them illegal, so we don't know the exact number, but it's a sizable number, and that seems to be putting downward pressure on wages. None of that seems to be impacted by whatever the Fed is doing with its monetary policy. So I think that to me is the tell that when the Fed basically says something that's obviously wrong, that kind of tells me that they want to cut rates no matter what. And I think that's, as we discussed earlier, very bullish. Now, the last thing that I want to talk about is how I think the housing market is going to surge this year. Now, let's zoom out a bit. So over the past year, we saw mortgage rates go as high as 8%, and many were expecting the housing market to absolutely tumble because of it. But that just didn't happen. A very common index for home prices is the Case-Shiller Home Price Index. And you can see that it surged during the pandemic era, and then when mortgage rates got really high, it basically just kind of paused a little bit. But what you don't see at all is a meaningful decline. Now, house prices, like anything else, is supply and demand. And as we all know, the supply has been constrained because many people are sitting on mortgage rates that are 4%, 3%, or something even with a 2% handle. And those people don't want to sell their homes because they think the mortgage is very valuable, which indeed it is. Now, if you have constrained supply, that's going to be supportive of prices. Going forward, though, that supply situation is probably not going to improve a whole lot, simply because that 2-3% mortgage just really is valuable. But demand is probably going to pick up. So if you look at mortgage rates over the past few months, you can see that the simple move from 8% to 7% mortgage rates stirred up a lot of activity in the resale market. Now, going forward, it's very likely that mortgage rates will continue to decline to have a 6% handle. On the one hand, so maybe, let's say the Fed cuts rates, maybe we have an accident, but I think that the spread between mortgage rates and the 10-year yield, which remains historically quite wide, is probably going to narrow as the markets have been quite calm. Now, I continue to think that we have a 10-year yield that will continue to drift higher this year, but as long as that spread between mortgage rates and the yield continues to narrow, then you could easily have a 6% handle mortgage. And that is probably going to unlock a whole lot of buying. Again, just the 8% mortgage rates were restrictive, was very straining. 7% stirred up a lot of interest. A 6% handle is probably going to do even more. But when we're looking at demand for homes, I think it's too narrow to focus on the people who have to buy with a mortgage. Now, many people have been saying, housing is unaffordable, looking at wages and looking at home prices. And that's correct. But again, that misses another big segment of buyers. That is to say, people who can buy without a mortgage. And there are many, many people like that. If you look at a recent earnings call from Toll Brothers, they'll tell you that 25% of their buyers buy all cash. Now, over the past few years, we've seen a tremendous surge in household wealth. Looking at Fed data, household wealth is at all-time highs. No surprise, equity markets at all-time highs and home prices remain elevated. So there's a lot of people who made a lot of money, either in crypto and equities and so forth, and can easily convert that wealth into an all-cash purchase of a home. With wealth at record highs, there's probably a lot of people who can do that. Now, just look at, let's say, home owners. About 40% of homeowners don't even have a mortgage. So they own tremendous amounts of equity in their house. Maybe they're boomers who bought 20, 30 years ago and so forth. Those guys can easily just sell their house and buy another one. Or just take off some equity and buy another one. Now, this surge, so you have a lot of people who could buy based on wealth, and you have a lot of people who could buy based on decreasing mortgage rates, so that's a lot of demand. Now, the potential rise in home prices seems to be well anticipated by the market. If you look at an index of home builders, you can see that they've surged to the moon and still look like they're poised to further take off. Now, looking into the earnings reports of these home builders, it becomes obvious why. Let's look at Pulte, for example, a very mainstream builder. Now, the surge in home prices has fattened Pulte's margins. Right now, they're about 30%. Pre-pandemic, they were about in the low 20s. Now, again, this tremendous surge in margins has made it possible for them to, offer sweeteners to home buyers, either buy down their mortgage, closing costs, and so forth, and still make a very handsome profit. So the market is also confirming that, it's going to be a very good year for home prices. So I think that if you are anticipating some kind of crash, and I know there have been many channels dooming about that, but I think that you're fighting the last war, and that just doesn't seem to be the case. And again, we are turning the corner in monetary policy. 8% mortgages is moving to 7 and maybe lower. So again, careful not to fight the last war. All right, so that's all I prepared for today. Thanks so much for tuning in. If you're interested in my thoughts, check out my blog at fedguy.com. And of course, if you're interested in learning more about markets, check out my courses at centralbanking101.com. Talk to you all next week.